Okay, so after step one research, we have a better understanding of the business model, business environment, and industry outlook for this company. Now we want to turn to a more quantitative way of analyzing this company. So we need to look into the financial data of this company. So step two will be financial ratio analysis, because this analysis help us to analyze data in a more organized and systematic manner. It basically provides us a new framework to do data analysis. So by converting the financial statement data into ratios, we are converting data into information. So for example, margin analysis tell us how much profit a company can make from each dollar of revenue it generates. And then turnover ratio analysis reveals how much revenue can be generated per unit of assets. So it's extremely important for us to understand how to identify a company's performance in terms of its financial ratio, instead of just the absolute number. This is the language that analysts and management will use to discuss the company's performance. And so we will use this language here to construct a forecast of future. Ratio analysis is traditionally used to evaluate historical data, but here we will also use the ratio to forecast future, and most importantly, use the ratio to evaluate the plausibility of our forecasted financial statement. There are basically two types of ratio. Time series analysis means you compare the company's ratio to their prior year's level. And then cross-sectional means you compare the ratio to the corresponding ratio in its competitor. Here, for valuation purpose, we will focus on time series data, but when you are doing relative analysis or industry analysis, you may want to look into cross-sectional data to compare your company's ratio with the competitor, and that will help you to identify the competitive advantage of the company. For example, if you see that your company's profit margin has consistently outperformed the industry average or the other competitor, that's a really good sign of the company's strengths in business. Next, we will further divide the ratios into 4 categories based on how they're connected to income statement and balance sheet. The first one is income statement ratio. We also call it profitability ratio, and those ratios are solely based on income statement items, and they're pretty simple and intuitive. I think you must be very familiar with gross profit to operating profit. So I want to talk more about efficiency ratio or turnover ratio. This ratio measures how efficiently management is using the asset to generate the revenue. We all know that the company have short-term asset, short-term liability, long-term asset, long-term liability. And then it's common for us to first calculate the ratios for the working capital components, such as inventory, accounts receivable, and accounts payable. Take inventory as example. So their inventory and turnover ratio tells us how many times the company has replaced and sell their inventory. If the ratio is very high, that probably means the company have very good sales, and then they probably have insufficient inventory. And if the ratio is too low, that implies the company have a weak sales, or they may have excess inventory in their warehouse. It's very similar for receivable and accounts payable. The other saying is fixed asset or long-term fixed asset, which is equal to total PP&E, property, plant, and equipment. So the way we use this ratio is that we have revenue forecasted for for the future. And then we look into the historical fixed asset turnover. And based on this two number, we back solve the appropriate or required level of fixed asset. And then in return, after we get the fixed asset, we will use the fixed asset to calculate depreciation in the income statement. So that's how you use income statement revenue to forecast the balance sheet asset, and then use the balance sheet asset to calculate the depreciation in the income statement. So these two statements are connected by this rate. It's very important to understand this. Next is liquidity and leverage. These two are solely based on balance sheet. So you can see that the probability, liquidity, and leverage is based only on income statement or balance sheet, but it's the efficiency ratio that's connecting these two. So this is where a lot of analysts will make mistake. They usually mix up different ratios, and then they forget which income statement item is connected to the balance sheet item. So you have to pay more attention to the efficiency ratio when you're doing evaluation. So let's go back to the liquidity. Liquidity tells us how quickly the company can convert their current asset to cash, and then use that money to pay bills to meet other short-term obligation. If you have enough cash, or if your current asset like accounts receivable, notes receivable can be quickly converted to cash, then you don't have to worry about not being able to pay bills or pay debt, pay interest expense. Among the three, quick ratio is the most important one. That's the current asset without inventory divided by current liability. We take out inventory here because company usually don't sell inventory to pay back bills, because inventory are used to generate revenue. So they will prefer to sell accounts receivable or other short-term asset first. Understanding what's the trend of the quick ratio will help you to gauge the company's liquidity and their financial strength over time. The last one is leverage. Leverage tells us the level of debt in a company. We all know that asset equal to equity plus debt. So if the company wants to increase asset, if they want to expand the business, they have to raise funds. And then there are two ways of doing that. One is issuing debt, the other issuing equity. And because the cost of debt is usually way lower than the cost of equity, so manager will prefer to issue debt instead of using equity. And then debt actually benefit a company as long as it doesn't overburden the company with interest expense. And then the problem with very high leverage is that if the company cannot generate enough cash flow to pay the bill, to pay interest expense or pay down the debt, they will need to sell assets. And if after they've sold up all asset that's owned by the equity holder, they will go bankrupt. So the more debt you have in your company, the less cushion you will have when you are facing insolvency issue. So during the COVID-19, we know a lot of restaurants have been closed. And so for those small businesses, they don't have any cash flow, but they still have to pay bill. They have to pay the rent. And then they have to pay interest expense or pay down the debt that they borrow from others. And if they don't have any cash in their deposit accounts, and if they cannot borrow any more money from banks, they will be insolvent. They want to go bankrupt. Their asset will be seized by the court, and then later on, those assets will be sold to pay back the debt holder. So liquidity and leverage are very important ratio for you to understand a company's health condition, their financial strength. It's important for you to it's important when you're doing credit analysis or default analysis. Next, I'm gonna use TSCO, tractor supplier, as an example. So here you can see a standardized financial ratio analysis spreadsheet. We have profitability, efficiency, liquidity, and leverage. And then from column C to column I, those are historical data. And from J to M, that's the number that's the metrics that we calculated based on historical data. And then for N onward, those are forecasted numbers. So as I mentioned, we usually start with revenue growth. Here, I use a very simple and basic way. I calculated 2014-2019 compounding annual growth rate, which is 7.9. I set this as the beginning growth rate, and 2.4 is my terminal growth rate. So I will use these two numbers and also the Excel function serials fill to automatically generate the growth rate based on linear regression. So you will need to click trend here, and then this is the revenue growth rate for my forecasted period. We have a lot of different ways doing revenue growth rate forecast. This one is solely based on historical data, but we have some analysts who break down revenue growth rate. We also have analysts do regression. Those are very interesting method of doing revenue. And here it's just a basic introduction. Elias will talk about more different revenue growth projection method later. So next is gross margin, SG&A, depreciation. These three are very simple, and you can see that historically they've been very stable. So I just use the median for the forecasting period. Next one, EBIT margin. You can see here there's an asterisk. That means we have run out of our degree of freedom. So now because we've forecast every item up there, so this is only a result, and then we use the EBIT margin to see whether our forecast is reasonable or not. Interest expense ratio. This is based on income statement interest expense and divided that by the interest-bearing debt. So we know there are two types of debt. One is interest-bearing, the other is non-interest-bearing. Debt liability, like accounts payable, we're not paying interest expense on those accounts payable, so they are not included here. This is only the interest-bearing long-term debt or current portion of long-term debt. And the other thing I want to point out is that this is the average balance. It's the beginning and ending average. It's not just the ending balance. Next, efficiency. You can see the inventory and gross PP&E accounts payable ratio are all very stable. So I just use the mean or the median for the forecasting period. This may not be the case for your company. So that's when you should conduct more research and then try to understand why there's a upward trend, why there's a downward trend, and then make judgments about what the future turnover ratio would be like. If you think the company is improving their efficiency, then you might want to increase their turnover ratio, the PP&E turnover ratio over time. If you think the company probably will have less efficient asset, then you would decrease that over time. Next, liquidity and leverage. They are similar to the EBIT margin here. We don't use those ratios to forecast the future, but we use them to analyze their historical performance, try to understand their financial strengths. But we also use them to gauge whether our forecast has been reasonable since. So next, what we do is to apply all of this ratio to income statement and to our balance sheet. Alice is going to talk about the details of this measure.